First of all, thank you very, very much for everybody to dialing in today. It's really good to have so many people on the call. It's really, really exciting being the first day after we've launched the VCT. Bear with me 1 minute, get the slides to move. Hopefully, there we go. Bit of a delay. For those of you that don't know me, my name is Jack Rose. I'm head of retail sales here at TriplePoint, and I'm really pleased to be joined by Seb Wallace, who is an investment director in our ventures team. Plan for today is to spend 30 minutes, no longer than 40 minutes, having a conversation, talking through our venture capital trust, our venture fund, VCT, really diving into, I think, what makes it a unique proposition in the market, why it benefits investors, how it separates itself and distinguishes itself from our peer group, and why we've had such traction over the last few years for our offering, with well over 200 people registered for this webinar. It's really fantastic to see such an appetite and people really buying into the investment strategy and what we're trying to do and what it offers investors. As I said, it's a really exciting time for us. I think this is our fifth offer that opened yesterday. We actually closed last offer, having raised all but £1 million. We did 19 of the £20 million in our fourth fundraise, and appetite for this offer seems to be just as strong, if not stronger. We're looking to raise 10 million with an over allotment of 20 million pounds. As I said, the offer is open now. We'll touch on that all in a bit more detail. I don't want to go into too much because I'll steal Seb's thunder, but perhaps as I pass on to the next slide, give you an opportunity to speak. I should say, if any of you have got questions as we're going through today, please don't hesitate to drop them into the Q&A. I probably will address them all at the end rather than interrupt the flow. Without further ado.
Yeah, awesome. No, thanks, Jack. Thanks. And it is great to have so many people. It's certainly easier doing it from a booth online and having 200 people in front of us would lose our voice by the end of it. But so a little bit about TriplePoint, just to set some context. TriplePoint's been around since 2004. Many of you will be familiar with us or one of our products that you will have either your clients will have either used before or you've at least considered. This is now the 26th VCT offer since we began. We began with VCTs back in 2004, and we've moved on since then. We're now at £3 billion of AUM in total, and VCTs sit within a wider strategy of managing retail, institutional, and indeed government money across 5 core strategies. Those strategies, just to recap, are digital infrastructure, energy infrastructure, social housing. They are all listed investment trusts, and then we have our private credit arm and our venture capital arm. And we're here today to talk about the venture capital arm, and specifically within that, our flagship fund, which is our VCT, or what we call the venture fund. And so really, if we could pop over to the next slide, I reckon. We can get talking about the strategy. So really, this VCT is specifically the venture share class is a reasonably new fund. It's established but new. It's a fifth offer now, so we've been running since 2018. We now have 37 companies invested in 38, and one recently exited, and that's why we're at 37. There will soon be you've got terrible echoing, you say. Yeah. Well, if you could just message us as we go, and if you're still having echoing, we'll try and address that. But I'll keep going for now, and feel free to drop another message if it's still echoing. So we have 37 companies now, soon to be well over 40, and diversification being a key part of what we do. TriplePoint's venture fund focuses on early stage investing, and what we mean by early stage is typically businesses that have less than £1 million of annualized revenue. And specifically within that, we focus on B2B technology. We focus on companies that are selling to other companies. The reason that we focus on B2B is because exits equal returns. As we all know, they drive the dividends in the long run for VCT funds and for NAV growth as well. And B2B typically exits 2 times more than B2C consumer, as they're sometimes called, companies do. If you just flip to the next slide.
You've literally stolen the thunder from your own slide.
Yeah. And so this is a graphical representation of the performance of consumer versus B2B companies. And this is one of the core reasons why we focus on B2B, because it delivers returns, it delivers exits, and therefore obviously growth.
When you say it's a comparison of performance, it's not a performance in terms of company performance, but performance in terms of exits.
Yes, yeah, specifically exits. And obviously in venture capital, exits are the key thing that we're looking for here. Yeah. Exactly. And then within B2B, as I said, we focus on the early stage. Now, the reason we focus on the early stage is because if you get in early, that's where you can drive the big returns. So, and this is a good graphical representation of how that really works. Simple graphic, but easy to digest. Now in the UK, over 60% of successful venture-backed exits were at values for the company of £50 million or less. And so it's really important, if you're trying to drive big returns, that you're investing early, where you can get a good multiple on your exit. So for us, we might invest in a company that's got a £5 million valuation. And then if that sells for that £50 million, we've just explained, it's done 10 times. Later VCTs, or the majority of the VCT market, and this is where we're a great complement if you're looking at a portfolio for your clients, focus at a little bit of a later stage. They typically focus at the £1 million mark as the beginning revenue they'll look at, maybe a little bit early, but a little bit earlier sometimes, but their core focus is at that later stage. And those companies may get in, those investors may get in a say a £10 million valuation. So they might do a 5 times return on a £50 million exit. And so by going slightly earlier, you can invest in the same cohort of companies in the UK, which is obviously UK technology, but deliver hopefully a better, stronger return, given that you're effectively coming in that bit earlier. Now, alongside that, there is some risk coming earlier, and therefore we mitigate that with diversification, what we call our challenge-led strategy.
Which comes on to our next slide.
Yeah, very neatly.
I'm going to just.
You'd have thought we prepared this.
Yeah, I was about to say, I'm going to just have to jump in, but otherwise you will just talk flat out. I think one of the bits just there on the 60%, that's data over the last 10 years or so, isn't it?
Yes, since 2011.
Yeah, since 2011. I think it's important as research we conducted with Bohurst.
Yeah. So Bohurst is a research agency based in London, and they focus on all sorts of new technology and startup analysis, and we work with them to effectively determine what this situation was, because we did have a real sense of it, but when we were developing our strategy, we wanted to put some data behind it.
And so aside from diversification, and you were just coming on to talking about it, kind of how do you describe challenge led, and where does that sit in this whole piece?
So challenge led. So because you're going that little bit earlier, typically the companies you're investing in, they can attract more risk. They're less proven out. They do have some proof points, but they're less proven than say £1 million, a business with £1 million of revenue. And so what we do is we focus on businesses that have established market fit with customers, and we do a lot of customer market referencing, and that's the challenge-led idea. We're looking at corporates that have problems, or what we call challenges, and companies that are therefore addressing those challenges. What we're not looking for are companies that have ideas of a product but have not got real evidence that there's commercial traction. And we, over the last 20 years of investing, almost 20 years to 18 years of investing at Triple Point, we've had the opportunity to develop a really, really top tier network of, whether that be funds, whether that be people working in corporates, whether that be people working as innovation consultants. And so we really tap into that network to help validate the ideas of that earlier stage. And that's one of the 2 things we do to address some of the risk with early stage investing. And as you can see here on this graph, you can see that run out of cash is number 1, but why do you run out of cash? Well, you run out of cash because of number 2 here, which is no market need. So well over 60%, 70% of companies fail because effectively they can't sell their products. They've got no need for it. And by working with our network and doing significant customer referencing at that early stage, we can start to establish whether there's market demand. It's not to say there always will be, it's not to say it's perfect, but it really helps mitigate that risk. The second thing we focus on is diversification. And diversification is important because at the early stage, you are really counting on breakout successes to drive your returns. And therefore, you need to be well spread out. And if you look at our portfolio, as I said, we had 37 companies, previously 38 before the exit. And we have, at the moment, £42 million of AUM in the fund. On a per £1 million of AUM basis, we have a very large number of portfolio companies compared to some other VCTs, and who are much more concentrated. And that's reflecting that early stage diversification of risk. But together, when you take these two elements and you put it with B2B and early stage, we really believe that that's the way to drive long-term returns, and not just NAV growth, but dividends in the future.
One of the questions we have had certainly over the last few months, and I know it's a question people do ask at periods like this, of is now a good opportunity to invest in venture capital given wider disruption in the markets? And I know there's a valuation point which we can come on to talk about when we get to the portfolio, but just more broadly about an opportunity for the types of companies that we look to invest in right now. Why do you think kind of this periods of recession, economic disruption create such an opportunity for companies like those that we're investing into?
Yeah, so there's sort of two things there. There's the specific economics now, and then there's the wider piece about disruption. And I think there's a lot of, nobody will have missed the discussion about, is there going to be a recession? Are we in a recession in the UK? And what does that mean? I mean, one of the most interesting historical facts is that in the UK and in the US, specifically those two geographies, in recessions, more companies get made. And some of the most well-known companies in the world today were founded in the 2008 crisis. And indeed have been being founded from 2020 onwards with COVID, now with obviously all this disruption and cost of living crisis. And so there is a great pool of opportunity for those companies. We don't quite know why it is, but more people start enterprises when they're new businesses, when they're in times of economic uncertainty.
There's also a piece about our strategy focusing on B2B, the issue of cost saving for large corporates, and actually the challenge of kind of becoming more efficient, and what our businesses are doing in terms of solving challenges becomes ever more acute, right?
Yeah, I think also if you look at a sort of long term, we would say an investment thesis, but the long term view on early stage B2B, we have an aging population. We will have 10 years from now, short of mass immigration, a shortage of workers in some way, and technology is going to be really important for not just driving productivity, but for driving ultimately the growth that we hope we will soon see. The one point I would pick up on just before you go back is the current environment right now, and we saw interest rates rise today. They're at 2.25% now. The B of E's raised them, and we've got inflation that's quite high. And in those times, there are very few assets that have returns that are uncorrelated to public markets, but also can beat inflation. You could put it in gold or in cash, but uncorrelated to the stock market, but you're not going to beat inflation. And early stage venture capital specifically, not late stage, early stage venture capital is a good asset to use in this time. And then of course you've got all the bit, because it's uncorrelated, but it can drive returns. And then, of course, you've got all the benefits of a normal VCT, which on top of that.
So we've spoken a little bit about kind of what underpins it and the thesis that sits behind our strategy, what makes it different, where the benefits for investors. I think if we come on to talking a little bit about how we've performed today over the last 4 to 5 years, I think that's a really good part to spend a lot of time on. And I am really obviously excited about where the portfolio is. I know you are as well, and lots of our investors have been talking about it, and perhaps just picking up on a few things in here, but focusing specifically on that graph on the left hand side in our portfolio at the moment. Is there anything in particular that you would raise out of it? I mean, it is slightly self-explanatory, but maybe a bit of explanation around what this graph is showing.
Yeah, I'd also, yeah, exactly. So this graph on the left hand side is showing effectively revenue at the point of investment, and revenue what is effectively almost three years on, not quite, but almost 3 years on. ARR stands for annual recurring revenue, or run rate revenue, which is very common in software businesses. And you can see that it was at 4 million, it's now 20 at 5x growth. Now, most of these businesses are valued on a revenue multiple basis, and so that is a proxy for future potential in the portfolio. Not all companies will have been marked up at this time, and we typically take a view that we mark up with third-party valuation rounds where possible. So some of our portfolio don't yet reflect the growth in the revenue here. But ultimately there is promise in that growth and what that could potentially mean over the coming years. And when you put that into context with the number in the portfolio that are also newer, there's a very large portion of the portfolio, about a third, that are newer businesses that are yet to be marked up in the earlier stage of their growth. And so there's really interesting opportunity for them in the future too. So I think those are probably the bits I would highlight for now.
Absolutely.
And then here we've obviously got the visual demonstration of the
performance. Yeah, I mean, it is fairly self-explanatory. The dip, I guess, just to comment on, was some provisions that we made in the portfolio back at the beginning of COVID. You know, as Seb pointed out, one of the key things that we would point out, and I know is highlighted by a number of the consultants as being a really conservative but really positive thing that we do, is we will only value companies up on third-party funding, on funding rounds that include third parties independent of Triple Point, but we will provision down on businesses where they either we're looking at a macro piece and think it's prudent to do so, or they're missing key KPIs in terms of the metrics that we're measuring them against. So we're conservative to value up, and we're very prudent on the valuations on the way down.
Yeah.
And obviously the performance from that low point in August 2020, after we paid the div, you know, has been really strong, with 9p of dividends now paid out to date. So that's been a 3p followed by a 3p followed by a 3p. We're targeting up to 5p per annum, and we'd hope to continue to trend towards that number from a base of 3p, which is obviously what we're paying at the moment. Moving on.
Yeah, so we talked a little bit about this. I mean, the portfolio's grown quite rapidly. We target 8 to 12 new investments a year. We'll continue to target that, and we would expect this to grow. Now it's grown very quickly over the last 4 years. In reality, we will expect to see some failures, and that's part of venture capital, and indeed we plan for that. We haven't had as many failures as we expected, and we expect that to happen. So the portfolio may stabilize around 50 or 60 companies, we expect, but it's certainly going to drive up from here. And if we want to, did you have a question?
No, I was going to ask, what kind of percentage of the fundraise would you see going forward used for new investments versus follow-on?
Yeah, probably around a third at the moment will be used for follow-on, and 2/3 will be used for new investing, and then that will trend probably closer to 50-50 over time, but not quite yet. And then this is obviously a representation of the sectors that we invest in. We're a generalist VCT and B2B, so as long as it's B2B, we can look at the sectors. But unsurprisingly, there are some focuses. We're London-based manager, and although we invest pan-UK, fintech is a major player in London. London is arguably the leading city in the world for fintech innovation, and therefore that unsurprisingly represents a significant portion of our portfolio. And insurtech, which is at 11% at the bottom, that's really could almost be branded with fintech. So it's about a third of the portfolios in fintech. Healthcare as well, an important part. We are the UK, we have the largest single payer healthcare system in the world. There's some huge opportunities there for digitization and efficiency, and hopefully some of the technology businesses we've invested in will do that.
Can I ask what middleware is?
Yeah, middleware
for us on tech people.
Yes, yeah. Well, even the tech savvy people debate about it. Middleware is the word given to businesses that effectively sit between a front end product you use, so you know, an app or something on the internet, and the back end databases. So it could be data flows, it could be input output communication, and in this particular case it's around RESTful APIs, which is effectively a way that data can be pulled from one system to another very quickly. And so middleware is the sort of the pipes that sit between pieces of software.
Okay, I sort of get that. I think this is a really interesting graphic, to really a visual demonstration of where we look to invest at the point of investment in companies, and a kind of a snapshot of where our portfolio is, to really show the kind of maturing nature of it. a fair representation of where you would expect it to be?
Yeah, and I think over time, what we'll see as the VCT continues to mature, we'll see more of that gold and light blue, that Series B, Series A, growing, because obviously portfolios stay in the company and they grow like that, and perhaps the seed and pre-seed shrinking as a proportion of the current portfolio. The left-hand side pie chart we would expect to remain the same, which is our core strategy, which our focus is to invest at seed stage, do a little bit of pre-seeders and a little bit of A as well, but seed stage is our core focus.
It's about 70% of the money we're investing, just under, right, at the moment, into
pre-seed and seed. Yeah, exactly.
And we define that as basically up to £1 million in revenue.
Up to £1 million in annual either recurring or run rate revenue for seed, and then pre-seed. That gap is, we really think of it as how many customers do they have, where's their product in development.
Fine. The snake.
Yeah, this snake is growing slowly but surely over time.
Well, not that slowly, really.
No, exactly. Yeah, it's growing. It's growing, and what we have seen to date with the NAV growth that we've experienced since 2020, when we did the COVID write-downs, is that top end and a little bit of the beginning of the 2020, around the 2021 mark. We're seeing those parts of the graph driving the returns, and from 2022 onwards, it's early days. We haven't had enough time for that to really drive returns yet, but you're looking there at a graphical representation of where we are very much hoping the future growth will come from. We will still see, of course, growth from the top of the snake as they continue to march onwards, but that bottom part is that piece of the portfolio that I mentioned earlier that is recent and has the potential to grow in both revenue and value.
So that annualized recurring revenue bar chart with the 458% growth in revenues is this cohort here on the top of the snake.
Yeah, mainly because obviously you need to give them time. Yeah, exactly.
So I think if we could move on to a couple of company examples, and I think we've got three in here, but we might end up just doing a couple in the interest of time. This is obviously one of the early businesses in the portfolio. Perhaps just talk through a little bit about what Semble, formerly known as Haydock, does, what the challenge it's looking to solve, and then maybe a little bit about its journey to date.
Yeah, so I don't know whether any of you have either friends or relatives that work in the health sector in the UK, but the systems they use to manage patients, or in the lingo PMS, patient management systems, PMS systems are quite outdated in a lot of the UK. And what that means is that for every 7-8 minutes that, say, for example, a GP spends on managing with a customer, they spend another 15 minutes fiddling around with the technology. And so really they just need better tech in order to service more patients. And we all know the strains that are happening at all levels of both the NHS, but also in private now. The NHS is using private. And what Semble have built is a modern new age PMS system that integrates into all sorts of layers in both hospitals and primary care. They started in primary care and they're expanding now into secondary care. And we invested in their seed round back when they were called Haydock, and since then they've really grown revenue phenomenally. Their seed round, they had a few $100,000 of revenue, and as of last week when I met up with the founders, they were at $3.5 million in revenue. So they've had a really solid couple of years, 3 years. And we would expect that to continue. And indeed, they're now looking at geographical expansion into other countries, having made significant headway in the UK now.
Why do you quote revenue in dollars? Is that just a venture thing?
That's how they quote it. So different companies quote in different ways, and often when they internationalize, they'll start quoting in dollars, because at some point they may be looking to the US for fundraising.
I was about to say, is it a US fundraising thing?
Yeah, and although these guys have only received European fundraising to date, like they now are discussing their revenue in dollars.
In the interest of time, I know we do have another example here of Viramark. Unless you want to talk on it, I was going to skip on and talk a little bit about Credit Kudos, because obviously
sure, happy to skip on.
We had a really exciting moment in the last year for the fund. We had the first cash exit. We have had a realization, we should say, before that, where we took shares in the consideration for Adepto. But perhaps talk us through the Credit Kudos transaction.
Yeah, so Credit Kudos, we invested in their Series A. We invested £500,000 in their Series A. Effectively, what Credit Kudos is, I'm sure you'll be familiar or know some people that have had this, but there's people called thin file applicants with credit. So they're people that just haven't used a lot of credit, and when they go and try and get credit, they get rejected because the credit referencing agencies can't work out whether they are good with their credit or not, so give them a bad credit rating. And there's a big opportunity there for financial service businesses, because they're effectively a wedge of people who are underserved but actually good with credit. And what Credit Kudos does is uses open banking to track and monitor, not on an ongoing basis, but to track and monitor on a snapshot basis, the banking transactions of these individuals. Obviously, it will be banking transactions because they won't have credit cards. And to create a view, an underwritten view of their creditworthiness. This then in turn allows businesses to okay credit for people who with the traditional referencing agencies may have been declined. This product was used by several customers, including Apple, and Apple have had their well-publicized move into fintech recently. They partnered with Goldman Sachs in the US. They are now moving into buy now, pay later, and they're generally looking to expand, obviously Apple Pay, which I'm sure many people use, and they're really looking to expand their fintech offering. And one part of that is having reliable and as cheap as possible credit referencing. And they were using credit Kudos, and they decided they wanted to buy the product wholesale. They paid $150 million in cash for Credit Kudos. And the VCT as a consequence, just under 2 years later, just under 2 years later, received almost about five times their money, its money back, 5.2 times gross. And then and that was obviously a key part of the dividend that people were received, or your clients may have received, their already existing clients earlier this month. And yeah, it was a real validation, a really good validation of the strategy, focusing on that challenge-led approach, going a bit early stage.
Perhaps a bit earlier than you would necessarily have anticipated, given that I know when we set this out, you were quick to tell us that you weren't going to have any exits for 5 years.
Yes, yeah. I think realistically, when we're investing in a company, we're not expecting them to be exiting for 5, but really 7, 8, 9, 10, sometimes 12 years in these days. The time from early investment to IPO or exit has really lengthened over the last decade.
I'm conscious on time and saying we would stick to the time frame that we set out. We're approaching the half-an-hour mark, so we're drawing to the close. If there are questions that people would like us to address, please do pop them into the chat box as we're getting to the end, and we'll come to those shortly. Just as a bit of a recap, we have just opened the latest top-up offer for the portfolio. As Seb said, we've got £42 million of AUM over 37 companies in the current portfolio, and we're looking to add an additional £10 million with a £20 million over allotment contingent on fundraising and deal flow. In terms of, for all of you, the kind of other key bits that I draw out, we do have early bird and existing shareholder discounts that run until the end of December. So please do speak to your business development manager at Triple Point, and they will happily talk you through all of that. We do have a formal buyback facility in place, and other areas that are probably of note. You can reinvest the dividends if you so choose. We can come on to talk about the advisor charging in 1 minute. And the only other thing that isn't on here, but I do always highlight it, I think, is you will see a considerable amount of money from, it's worth pointing out that Triple Point as a team have invested a considerable amount of their own money in this offer. Both the investment team, friends and family, and the wider Triple Point group have supported the fund to the tune of about £400,000, I think it is now, and it's not an insignificant sum of money. And I think it's something that I really highlight to people as being an alignment of interests, making sure that we have skin in the game on exactly the same term as our investors. And I think that's really, really important. So it's something that I would highlight out to everybody on the call today. It's being a small point not on the slides. This is a picture of the team, Seb there in the middle. I guess just in a nutshell, what makes for a good ventures team? What's
well, the word I use. I always say a good venture team's like the Avengers. A good ventures team should really have a variety of experience, and there are 5 or 6 things that make a good venture capital investor. There's obviously financial experience, there's being a founder or having worked in a startup, there's being an accountant or understanding accountancy intimately, being a lawyer, being a banker. So there are all these different varieties of background that people can have, and that's what we try and represent in our team. Ian, who's one of the partners in the team, His background was previously, he was actually the global head of strategy at UBS, and he's worked at Triple Point for over 10 years and in a variety of roles across different asset classes. As me, of course, I was part of the with Ian and one other individual, we co-founded the ventures investing at Triple Point. Manuel's joined us. He's a previous founder himself and also was an investor at Mustard Seed Maize. And then Claire, who was the managing partner of Triple Point, is the chair of RIC. And then you've got Chris. He was actually an entrepreneur in Russia. He had one of the first telesales businesses out there in the 90s. And Jamie's recently joined us from Barclays Investment Bank. Ethan is our portfolio associate. And then alongside the main team, we have our advisory committee. Our advisory committee is Christian and Charlie, who are both veteran entrepreneurs in the UK startup ecosystem. Both have started businesses that are worth 9 figures now. And we look to them to help the portfolio, to get advice where we need it, and to generally talk about the market.
That is good. 2 seconds, just clicking on. As I mentioned charges earlier, I won't dwell on this too much because anyone that is interested, we can pick this up at a later date, but charges are fairly standard. The initial fees 2.5% from Triple Point's perspective for advice clients, and we can facilitate up to 4.5% facilitated advisor charges, both initial and ongoing for advisors, subject to obviously clients signing up to it all. There is a performance fee on performance gains in the portfolio over a hurdle of 3% compounded each year, which I will mention here as well. And as I said at the beginning, there are some existing shareholder and early bird discounts that essentially for our existing supporters that want to come in before the end of December, will be getting in at 0.5% as opposed to 2.5%. So it's a good opportunity for people who want to make a move early. And the VCT will stay open until the 5th of April, subject to obviously fundraising and available capacity. And that really draws what I'm going to talk to you all about today. I think we finished this in a fairly prompt time of about 30 minutes, which is what I was aiming for. I guess, as I mentioned, if there are any questions, I'll just hold on for a moment or so and just see if there's anything. There is a question that's popped up. Hold on. No problem at all. Yes, we will send out the slides. There is going to be a follow-up email that's going to go straight after this, and we will make sure that the slides are included as part of that. So yeah, don't worry, we will make sure we send those out to you after this.